Here's a painful truth. Over 99% of IUL policies are structured wrong. By the time most families find out, it's years later, after hidden fees and bad design have already eaten away their retirement savings. But here's the good news. If you know the 10 questions the wealthy always ask before signing, you can instantly spot a smart IUL versus one that could cost you tens of thousands. Most agents hope you never ask these, but today, you'll know them all, and you'll never look at an IUL the same way again. Here's what you'll walk away with today. First, a 10-question checklist that instantly tells you if an IUL is designed to build wealth or designed to drain it. Second, you'll finally understand the key moving parts, like participation rates, cap rates, and policy loans, in plain English, without the alphabet soup of financial jargon. And third, you'll know the red flags to watch out for when talking to an agent, the kind of signals that should make you hit pause faster than a bad Yelp review. Oh, and stick with me until the very end, because I'll also share a bonus tool that makes navigating all this 10 times easier. You'll want this in your back pocket before you ever sign an IUL contract. Bottom line, you'll have the clarity and confidence to protect yourself, ask smarter questions, and avoid becoming another 99% statistic. If we haven't met yet, my name is Robert Balgak, founder and CEO of Black Swan Insurance Group. Since 2017, my team and I have helped over 20,000 families create tax-free retirement solutions and protect their legacies, backed by hundreds of 5-star reviews on Google. Now, let me make one thing crystal clear. An Indexed Universal Life Policy, or IUL, is not an investment. It's a life insurance product, structured under IRS Code 7702, designed to provide long-term protection and tax advantages when set up properly. So why do so many smart professionals, doctors, attorneys, tech executives, feel frustrated when they look into IULs? Because the industry has a big villain problem: hidden fees buried in fine print, bad designs that eat away at your cash value, and of course, the IRS waiting patiently to take its cut of your hard-earned savings. And if you've ever sat across from an agent who threw acronyms at you like alphabet soup, you know exactly what I'm talking about. That's why I'm making this video. My mission today is simple: to arm you with the 10 must-ask questions that instantly reveal whether a policy is built to protect your wealth or just to pad someone else's commission. Picture this. You scored tickets to see U2 live. The energy's insane, Bono's belting it out, and the whole stadium is waiting for the encore, where the streets have no name. But just before it starts, security waves you out. Your ticket didn't cover the encore. That's exactly what a participation rate does in an IUL. If the market rises 10% and your policy's participation rate is only 50%, you only get 5%. Some policies give you 100%, some higher, some lower, but it's one of the biggest levers that determines how your cash value grows. So your must-ask question is, what is the participation rate on this policy, and how has it changed over the past 10 years? Red flags to watch for: the agent can't explain participation in plain English. They only quote today's rate, without showing a history of changes. They say it's always 100%, without clarifying exceptions. Because participation rate is your concert ticket. If you don't ask, you might think you're front row at U2, only to find out you've been escorted out before the encore. If the participation rate is your ticket into the concert, the cap rate is the governor on your financial engine. Here's what I mean. The market could roar ahead with a 20% gain, but if your cap is 11%, that's the maximum your policy will credit. Even if you're driving a Ferrari, the governor kicks in and locks you at that top speed. Now, this isn't necessarily bad. That governor is what helps pay for the 0% floor, meaning when markets crash, you don't lose value. But if you don't know your cap, you might assume you're cruising with the market, when in reality, you're capped at a much lower speed. The must-ask question: what is the current cap rate on this policy, and how has it changed over the past 10 years? Red flags. The agent avoids showing historical cap changes. They promise unlimited growth. Caps are always real. They fail to explain the trade-off: a cap in exchange for protection. Because knowing your cap is like checking for a governor before a road trip. If you don't, you might expect Autobahn speeds, only to discover your engine shuts down at 65 miles per hour. Think of your IUL like owning a house with utilities. As long as you keep the lights on, the fridge running, and the heat paid for, the house stays livable. Stop paying the basics, things shut down fast. That's what the minimum premium is inside an IUL. It's the lowest amount you must pay to keep the policy alive. Fall below that, and the insurance costs start eating your cash value until the policy eventually lapses. The must-ask question: what is the absolute minimum premium I need to keep this policy in force? Red flags. The agent avoids giving you a number. They only talk about the target premium. No explanation of what happens if you only pay the minimum. Because at the end of the day, you can't keep the lights on in a house without paying the utility bill, and you can't keep an IUL alive without knowing your minimum premium. An IUL is like filling a big coffee cup. Pour in the right amount and you've got a solid, energizing plan. But overfill it and now it's spilling everywhere. Hot mess on your desk, and you've lost the whole point of having the cup. That's what happens if you put too much money into a MAC too quickly. You cross IRS limits, and the policy becomes a modified endowment contract, or MAC. And once that happens, you lose one of the best features, the ability to access your gains tax-free. The must-ask question, what is the maximum amount I can contribute each year without turning this into a MAC? Red flags. The agent doesn't mention MAC rules at all. They only show a maximum funded illustration with no explanation of tax limits. They make it sound like you can dump in unlimited money without consequences. Because just like pouring coffee, the secret isn't how fast you fill the cup. It's knowing exactly where the rim is, so you don't burn yourself later. Choosing between option A and option B for your IUL's death benefit is like choosing between a fixed-price dinner and an all-you-can-eat buffet. Option A, level death benefit. Think fixed-price meal. The death benefit stays the same. As your cash value grows, the cost of pure insurance goes down, making it cheaper over time. But when you pass, your heirs only get the death benefit. The insurance company keeps your cash value. Option B, increasing death benefit. That's your buffet. As your cash value grows, the death benefit grows too. Your family receives both the insurance and your cash value combined. The trade-off? Higher ongoing costs, because the insurer is always covering a bigger risk amount. The must-ask question, which death benefit option, A or B, is this policy set up with? And why? Red flags. The agent can't explain the difference clearly. They default you to option A without asking about your goals. No plan for how costs and benefits change as you age. Pro strategy. Many successful professionals choose option B during their funding years, often until age 65, to maximize growth and build cash value faster. Then they switch to option A in retirement to lock in a strong death benefit while keeping insurance costs under control. Because just like dinner, you don't want to pay buffet prices forever. Start with the buffet when you're hungry and building, then switch to the fixed meal once you've filled your plate. One of the biggest misconceptions about IULs is that your money is invested directly in the stock market. It's not. Your cash value stays safe with the insurance company. What actually happens is they use out-of-the-money call options to link your growth to an index. Think of it like choosing rides at Disneyland. The park itself is safe, but you pick which rides you want to go on. The S&P 500 coaster. The classic ride with big ups, but a cap on how high it goes. The multi-year adventure. A longer ride that can pay off with higher caps, if you're patient. The volatility control ride. Smoother, less wild, built to give you steadier returns. Each option has trade-offs. Some give you bigger growth potential, others focus on consistency, and the smart move is often to diversify across multiple rides, not just stick with one. The must-ask question, what indexing strategies does this policy offer, and how can I diversify between them? Red flags. The agent only mentions the S&P 500, no explanation of how volatility control strategies work. They insist there's one best option for everyone, because indexing in an IUL is just like picking your rides. You want a lineup that matches your comfort level, not a one-size-fits-all ticket. Here's where a lot of people get both excited and confused. With an IUL, you don't withdraw money. You borrow against your cash value. The insurance company lends you the money using your cash value as collateral, while your account can still earn index credits. Think of it like borrowing against the equity in your home. You still own the house, it can keep appreciating, and you're just tapping into the value without selling it. Same idea here. Your money stays in the policy, potentially earning interest, while you borrow against it. There are two main flavors. Fixed loans, predictable interest, but the borrowed amount is usually moved out of the index account. Participating loans, the borrowed amount stays in the index account, so it can still earn credits while you're using it. The must-ask question. How do loans work in this policy? Fixed or participating? And what's the net cost over time? Red flags. The agent just says tax-free income without explaining the mechanics. No clarity on how loan interest is charged or credited. No warning about what happens if loans get too large and the policy lapses. Done right, policy loans are one of the most powerful features of an IUL. Done wrong, they can turn into a financial mess you never saw coming. One of the biggest reasons professionals look at IULs is the tax treatment. When structured properly, you can enjoy tax-deferred growth, tax-free access through loans, and tax-free wealth transfer to your heirs. But here's the catch. If your policy ever becomes a modified endowment contract, or MAC, the rules change overnight. Loans and withdrawals that should have been tax-free suddenly become taxable. And if you're under 59 and a half, you could even get slapped with penalties. Think of it like airport security. Follow the rules, liquids under 3 ounces, shoes off, laptop out of the bag, and you breeze through to your gate. But break the rules, and suddenly you're pulled aside. They open your bag, dig through your stuff, and confiscate your favorite razor you just ordered from Amazon. Now you're embarrassed, frustrated, and late for your flight. The must-ask question, what happens if this policy becomes a MAC? Red flags. The agent never explains what a MAC is. They brush it off as not a big deal. They promise always tax-free with no conditions. Bottom line, MAC status is the financial equivalent of airport security taking your Amazon package. It's painful, avoidable, and ruins your trip. Ask up front so you don't get blindsided. Every IUL comes with an illustration, a glossy projection of how your cash value might grow. But here's the truth. Those numbers are just assumptions. The future doesn't always follow the script. If the index earns less than expected, or the insurer lowers cap or participation rates, your policy could underperform. And when that happens, costs don't pause. They keep pulling from your cash value, which can drain it faster than most people realize. It's like buying a Peloton during lockdown. In the brochure, it's the perfect fitness solution. In reality, for a lot of people, it turned into a very expensive coat rack. The promise only works if reality matches the plan. The must-ask question. What happens if this policy underperforms compared to the illustration? Red flags. The agent only shows you the rosy, best-case numbers. No clear explanation of what happens if you hit several 0% credit years. They brush it off with, don't worry, it always works out. Bottom line, a properly designed IUL should be stress-tested to survive tough years. Not just look pretty in a brochure. If your agent can't show you the downside, that's your sign to walk away. An IUL isn't a set-it-and-forget-it product. It needs ongoing care because caps change, participation rates adjust, your funding can shift, and your life will definitely change. Think of it like a garden. Plant it once and walk away, and weeds take over. But give it regular care, water it, prune it, adjust for the seasons, and it grows into something strong, healthy, and lasting. It's the same with an IUL. Without annual reviews, a policy that started off beautifully can drift off course. The must-ask question, what ongoing service and annual reviews will I get with this policy? Red flags. The agent says, don't worry, it runs itself. No mention of annual reviews or performance check-ins. No plan for adjusting strategy as your needs or caps change. Because here's the truth. Planting the seed is only step one. It's the ongoing care, the right gardener, the right adjustments. That determines whether your IUL becomes a thriving orchard or a forgotten weed patch. At the start of this video, I promised you a bonus. And here it is. Now, even though you've got this 10-question checklist, I know some of you are thinking, Robert, this is great, but how do these answers apply to my exact situation, my income, my age, my retirement goals? That's exactly why we built IUL Custom GPT. It's a free AI-powered assistant designed to give you personalized answers about indexed universal life. Think of it as having the smartest IUL strategist in your pocket, available 24/7. Wondering how much you can contribute without creating MEC? Ask it. Debating option A versus option B for your age? Ask it. Curious how caps and participation rates could impact your retirement? Ask it. And here's the best part. It's completely private, no sales pressure, no awkward conversations, just clear instant guidance tailored to you. You can try it today for free using the link right below this video. All right, let's quickly recap the 10 questions you should always ask before buying an IUL. 1. What is the participation rate and how has it changed over time? 2. What is the cap rate and how often has it been adjusted? 3. What is the absolute minimum premium I need to keep this policy in force? 4. What is the maximum I can contribute each year without triggering a MAC? 5. Which death benefit option, A or B, is this policy set up with and why? 6. What indexing strategies does this policy offer and can I diversify between them? 7. How do loans work in this policy, fixed or participating? And what's the net cost over time? 8. What happens if this policy becomes a MAC? 9. What happens if the policy underperforms compared to the illustration? 10. What ongoing service and annual reviews will I get with this policy? Now remember, over 99% of IULs are structured wrong, and families don't find out until it's too late. These 10 questions are your shield. Ask them, and you'll know in minutes whether a policy is built to protect your wealth or designed to drain it. This checklist is how you stay out of the 99% and step into the 1% of people who use IULs the way they were truly meant to be used. So where do you go from here? If you're ready to put these 10 questions to work and design a policy built for your goals, here's the next step. Book your free tax-free wealth strategy session using the link below. We'll walk through your income, your retirement targets, and make sure your policy is structured the right way. not the 99% way. Or, if you'd rather keep learning before talking to someone, check out our next video. In it, I'll show you exactly how to max fund an IUL the smart way, so you get the most growth while staying within IRS limits. You'll find it linked right here on screen. Either way, whether you book your free strategy session now or dive into the next video, you'll leave with clarity, confidence, and the peace of mind that you're making the smartest move for your future. And remember, it's not what you earn, it's what you keep. Enjoy the ride.